Welcome to Blind Squirrel Macro, the pod, our usual companion to our weekly newsletter. Squirrel coming to you on the morning of Monday the 25th of November, Melbourne time. Quick reminder to make sure that you get the show notes for charts and links, and they'll be particularly useful this week. If you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. Anyway, before we start, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent. Talk to a financial advisor. Now, last week we touched on mobile banking in the context of Africa, and this took the squirrel down a fintech rabbit hole. Why have the Charlie Munger fan clubs started salivating over Square and PayPal? Are these now value stocks? Or are the recent moves just being pulled along by some kind of crypto momentum slipstream? This week, your rodent is going nuts with digital payments. For the majority of my adult life, the idea of leaving home without a wedge of folding cash in the hip pocket was right up there with not wearing trousers. However, my transition to a cashless world bore no similarity to an Ernest Hemingway slowly then suddenly bankruptcy. It was very sudden indeed. After nearly 3 years in Australia, I now handle cash so infrequently that I think I would end up panicking and using up one of my lifelines on the Who Wants to Be a Millionaire game show if I got a question on the colour of the various denominations of the local banknotes. Cash as a form of payment is so close to extinction in Australia that the country's only remaining cash courier nearly went out of business in June, and the current administration is having to introduce legislation to protect it. Obviously, the shrinking role of cash is not just an Aussie story. I'll spare you the tales about early morning panics in the squirrel household to find a $5 bill for the school charity day. Melbourne schools would appear to be the final holdouts when it comes to digital wallet adoption. But let's have a think about those. It's not escaped this rodent's notice that some of my favourite value investor follows have started making noises about the main protagonist of the greatest ever mugging performed on Silicon Valley by Team Australia. I refer, of course, to Square, now Block, and its 2021 purchase of Afterpay. To be honest, this rodent's brackets Afterpay's buy now, pay later business along with payday loans and other forms of predatory credit. It just comes with much better public relations and I guess fewer broken kneecaps. AI-powered credit underwriting algorithms may sound very clever indeed, but are yet to be fully tested. Post-election, buy now, pay later players may now be less worried about Elizabeth Warren and co. and all that regulatory scrutiny, but let's see what a proper credit down cycle does to them. I suspect that the recent Lazarus-like breakout of Square has more to do with the emergence of the US's first crypto-sympathetic administration than anything else. We shall see. The same crypto effect can probably be said of PayPal. This is, of course, the payments business which acted as the financial springboard for so many of President-elect Trump's West Coast financial backers, aka the PayPal Mafia. This week's piece will not be focusing on the crypto side of fintech, and this rodent is even less interested in loan sharking. I may return to that topic when and if Sweden's Klarna files its registration statement with the SEC for its IPO. A successful IPO of Klarna could reopen the market for a long queue of arguably more interesting fintech unicorns. Instead, I want to dive into the opportunity among players within the processing plumbing of the fiat digital payment system. Frankly, the buzzwords and acronyms of the world of digital payments are confusing. Let me try and help you distinguish between your digital wallets, your ISVs, your ISOs, your MSPs, your PSPs, and your PayFacs. By the way, there are some pretty helpful diagrams in the show notes for this. Now, the term ISO, or Independent Sales Organization, and MSP, Member Service Provider, comes from the traditional world of Visa and MasterCard's credit card and debit card duopoly. They are merchant account providers that act as the interface between merchants and the acquiring banks. In the Visa system, they're called ISOs, and in the MasterCard system, MSPs. Pretty easy. Familiar names that do this would be brands like Clearant, EVO Payments, and Fidelity Payment Services. Now, PSPs, which are payment service providers or payment service processors, and their newer PayFacs, short for payment facilitators, come from the modern world in which sub-merchants are aggregated and have no direct ISO or MSP relationship. PSPs are companies like Fidelity National Information Services, Fiserv, and Global Payments. PayFacs are where the modern fintech household names come in. Think PayPal, who actually invented the aggregator model, Square, Stripe, and Europe's Adyen. The advantage of the aggregator model for merchants is that they were created in and designed for the digital world of e-commerce. Streamlined onboarding with light to zero documentation and no requirement for separate bank accounts means that individuals and small businesses can be set up to receive payments almost instantaneously. Getting set up directly, by contrast with a traditional MSP or ISO, is a bureaucratic nightmare, but it does usually mean that you at least have a phone number to call if something goes wrong. Sub-merchants under the PSP and PayFac models do not have this luxury and are also exposed to the risks created by their fellow sub-merchants if breaches are deemed by the compliance departments of the ultimate acquiring bank to have been made. The relationship between acquiring banks and the world of fintech has not been smooth sailing of late. Wells Fargo, for example, recently debanked Square, Stripe, and PayPal. It's amazing, really, quite how fragile some of these PayFacs connections to the banking system are. To confuse matters further, many of these fintechs operate in multiple capacities. ISVs, or independent software vendors, are a software as a service layer on top of the payment processing experience. Stripe, Square, and PayPal, as well as Toast for US restaurants, are examples of this, but there are plenty of ISVs that operate a SaaS front end without the payment processing back end. These new financial intermediaries are taking market share and margin from the legacy payment processors. ISVs and PayFacs are creating one-stop shop apps and platforms customized for the point of sale and customer relationship management, or CRM, systems of small and medium-sized merchants. For online shopping, both in platforms and marketplace, and in-person shopping and dining, these value-added software services are sufficiently sticky and profitable that some ISVs end up outsourcing the messy process of actual payment processing to the merchant acquirers, at wholesale prices, of course. Now let's think about the broader outlook for the payments market. This area is well covered by big consulting. Never let it be forgotten that industries such as banking, with wide moats to defend, are a target-rich environment for those in the business of selling billable hours. The world's banks are also burdened with a patchwork quilt of legacy accounting and payment software that cannot, of course, be switched out overnight. Failures of legacy IT systems have a habit of justifying the requirement of third-party IT consultant reviews after the nasty headlines hit. The good news about this focus on the sector from the consultants is that they have put together some great data for us. According to Boston Consulting Group, global payment transaction revenue compounded at 8.7% over the 5 years between 2018 and 2023. Growth in developed markets, i.e. North America and Europe, is expected to decelerate to a low single-digit rate between now and the end of the decade. However, a significant and continued growth runway is still forecast for emerging markets. This developed market, emerging market distinction is understandable. The market position of legacy digital payment systems is much more entrenched in more developed markets where we've all been using credit and debit cards for years. Transaction revenue growth in the emerging world should continue to outstrip broader economic growth as a function of digital payments taking share from cash transactions. Emerging market payments companies will, of course, however, have to share that growth with some of the central bank-sponsored instant payment rails that have been set up, such as UPI in India and Pix in Brazil. Now, we do listen to a lot of hot air from the VCs and the fintech evangelists promising transformative productivity and growth vectors. But let's not forget that payments are, at their core, a simple fee plus float business. What really caught my eye from the BCG forecast was the collapse in growth of what they call non-transaction related revenue in the next 5 years. Now, most of this component of revenue is interest income on merchant float, i.e. their cash balances. McKinsey estimates that net interest income contributes almost 47% of total payments revenues. It strikes me that these forecasts are baking in some fairly significant assumptions for cuts in interest rates without saying so explicitly. In a higher for longer rates world, I suspect we should see much higher overall transaction revenue volumes for payment processors. The industry may end up needing that growth. One, there is plenty of competition for the revenue pool. Boston Consulting is tracking more than 6,500 active payments-focused fintech businesses globally. And of course, financial crime and cyber risk is growing at an even faster pace than the fintech startups. Regulators are demanding that both incumbent and insurgent players in the payment space raise their game in response. This must represent a further headwind to payments margins unless AI can do much of the compliance heavy lifting in a cost-effective manner. In terms of investment in the future of payments, the Squirrel senses that a fair degree of selectivity is warranted, both in terms of geographical and market segment focus. Section 2 of this week's written note is a deep dive into that investable landscape as we hunt down our payment acorn. Get more digital rodent at blindsquirrelmacro.com. You can also find me on Twitter at squirrelmacro and on Blue Sky at blindsquirrel. Thanks again for listening. Please do spread the word. Squirrel out.